Jordan Dove here, coming to you from the offices of Dove and Associates, powered by Nationwide Realty in beautiful Las Vegas, Nevada. Today is February 27th, 2023, and as always, I just wanted to thank you for being here, watching the video, checking out the channel. Listen, the data and the information that I want to provide is so that when you hear these headlines, these fear-mongering headlines by those pundits on those mainstream channels, you don't get scared. I'm going to give it to you guys straight how it is, what I am seeing, practicing every day in the real estate and economic realm, okay? So turn off those TVs, turn up the YouTube channel, and let's get right into it. So let's get into the market pulse for this week. I'm going to start off with our quote by Snoop D-O-double-G. If you don't know who that is, he's an American hip-hop recording artist and songwriter, and he was in with Dre and NWA and Eazy-E and all that crowd. So he said, if you don't own land, you don't own anything. He said this recently, and it's making its trends and its rounds around TikTok and Instagram in the real estate realm. So let's talk about some of our highlighted topics today. Vegas demand is skyrocketing compared to recent months as inventory continues to tank. Inventory keeps shrinking and demand is rising. We'll talk more about that in a little bit. Treasury bonds are going to the moon again, which does not bode well for mortgage rates. National housing news, new home sales jump and resales have dipped, and consumer debt hits new record highs, over $16 trillion. So let's go ahead and get into it. If you guys do not receive this email, it's sent every Monday, so you can get all the data and charts nice and pretty to your email, delivered to your inbox. Go ahead and click the link to subscribe to the newsletter inside the description of this video. So just look down below, click the link, enter your email address, and you will start receiving these, all right? Let's review last week. The stock markets, as you already know, they tanked as investors reacted poorly to hotter than expected inflation data, indicating the Fed would push rates higher and keep them there longer than once expected. So if you recall, they kept talking about, hey, we're going to get a pause here. The economy seems to be slowing down. That is not true. That was fake news, and we had a bear market rally last month. It was absolutely fake. All right, PCE prices, which is the Fed's favorite inflation measure, went up 0.6% in January, rising to a 5.4% annual rate. That moved further away from the Fed's target of 2% inflation. And it didn't help that consumer income and spending gains didn't show a cooling economy. So here's a positive note, if you want to spin it as positive. The St. Louis Fed president remarked it appears that the Fed may be able to disinflate in an orderly manner and achieve a relatively soft landing, meaning no recession. So yeah, let's hope so. When have we heard this before? A soft landing. We were hearing it months and months ago, but we were talking about this over a year ago now, that what was coming, all right? Now, a soft landing, and we have our government sending billions of dollars overseas to Ukraine for a war that, in my opinion, we have no business being in, but we can't send aid to East Palestine, Ohio, where a train derailed and has toxic chemicals making people sick, but we can't put funds there because we don't have any, because we're sending it overseas. Absolute nonsense. Take care of the people in this country and its citizens first. Fix our homeless veterans problem, fix our bridges, fix our infrastructure, fix our train tracks. I don't care what you do, but spend the money at home, all right? Anyways, the week ended with the Dow down 3%, the S&P down 2.7%, and the NASDAQ down 3.3%. Inflation-hating bonds also declined overall. The UMBS 5.5%, dropping 0.8 to $99.21. The primary mortgage market survey by Freddie Mac reported an uptick in the national average 30-year fixed mortgage rate. So remember that rates can be extremely volatile. So if you need a mortgage lender, ask me, shoot me an email, send me a text, call me. I have lenders licensed all over the country who are real professionals. I can help you. My contact information is in the description of the video. Let's move into our national housing market update. New home sales jumped 7.2% in January, and that's up for the second month in a row. Even better, the median price is below a year ago, and inventories have made big gains, reaching a 7.9 month supply, giving buyers more options. This is for new construction homes, okay? New houses sold in January about 670,000, and new ones for sale 439,000, with the median sales price of 427.5. The next release will be March 23rd, and we will make sure you guys get that. But listen, if you're in the market to buy, right now, the best opportunities are buying new construction because your agent can negotiate with you a reduced purchase price, a permanent 30-year rate buy down. We just had a client get a rate in the fours that the builder paid for. You can also get the upgrades. You don't have the delays in construction because a lot of them are already done and you have quick move-in. You just have to get through underwriting. You can also get all your closing costs paid for minus a small deposit of, for our clients who just closed last week, $1,000. They were $1,000 out of pocket minus their down payment, and they got their rate bought down by the builder. That is where some great opportunities are. I don't know how long it's going to take for resales to catch up. We are seeing more seller concessions and resales, but your average lender can't compete with the builders to buy down those rates permanently because that's built into the price for the builders, all right? Now, speaking of existing home sales, they slipped 0.7% in January, but good news came with the annual median price gain falling for the 7th straight month, now just 1.3% up from a year ago. Plus, listings rose and are up 15.3% from a year ago. January's dip was the smallest in a year, prompting the National Association of Realtors to observe home sales are bottoming out, with lower-priced regions witnessing modest growth and more expensive regions experiencing decline. Now, this is a national overall snapshot at what's going on. By region, this changes. By state, by locality, by county, it is different. But this is an overall snapshot. In Las Vegas, we have shrinking inventory in the resale market, and we have increasing demand, which shot our absorption rate figure up, which is a measure of supply and demand. It shot that figure up, and we're going to go through that in just a little bit. But a little did you know, more home shoppers are on the move. Realtor.com reports in the last 3 months of 2022, 55.5% of all listing page views in the top 100 metros were from homes outside of the area where shoppers lived. It looks like people are getting ready to possibly either move back to where they came from due to the pandemic shift, where people could work remotely as the companies and the employers are bringing their workers back to the office, or people are just looking for a fresh start. They want to get the hell out of Dodge. They don't like where they're at. So it's going to be very interesting to watch that trend, all right? Let's go over some economic notes. The Fed said that they cannot tame inflation. The Fed didn't say this. Sorry, this was a paper that's said by former Fed governor. But the Fed cannot tame inflation without significantly more hikes that will cause a recession. Former Fed Governor Frederick Mishkin is among the authors of the white paper that examines the history of central bank efforts to create disinflation. Despite the sentiments of many current Fed officials that they can manage a quote-unquote soft landing that we just talked about while tackling high prices, the paper says that it is unlikely to be the case. We find no instance in which a central bank-induced disinflation occurred without a recession, said the paper, co-authored by economists Stephen Cacchetti and Michael Ferroli, Peter Hooper, and Kermit Schoenholtz. All right. The key inflation measure rose 0.6% in January, more than expected. That was the CPE that we talked about, and it was up 4.7% from a year ago. Headline inflation increased 0.6% and 5.4% respectively. All the numbers were higher than the estimates. The numbers suggest inflation accelerated to start the new year, putting the Fed in a position where it will likely continue to raise interest rates. Consumer debt, this is so bad, but consumer debt hits a record $16.9 trillion as delinquencies also rise. Consumer debt across all categories totaled $16.9 trillion, up $1.3 trillion from a year ago as balances rose in all major categories. Mortgages, auto loans, and credit card delinquencies all increased, though at still low levels, they say. The rise in balances came amid an aggressive rate hiking campaign by the Fed. What do you guys think of that? Let me know in the comments, but let's talk about our Treasury bond yields. Now, the 30-year, our last reading was 2 weeks ago. We did not do a reading last Monday due to holiday. 30-year, 3.932%. That's up 14 basis points from 2 weeks ago. 10-year at 3.922, up 20.3 basis points. 5-year up 24.8 basis points to 4.171, and the 2-year at 4.782%, up 24.8 basis points. The 5 and the 2 moved in correlation with each other, up the same amount of basis points or percentage points. The 30-year is almost caught up to the 10-year. The 10 is almost surpassing the 30-year, where we almost have a true inversion, with the 2 being higher than the 5, which is higher than the 10, which is higher than the 30. I think that might happen again soon. But let's look at the 2 and 10-year spread on this chart right here. It's inverted even larger. We're sitting at 86 basis points. That is almost an entire percent point spread. Look at this chart going back to 1992. So 1 month chart, and look how negative we are. Look where we are now, and nothing comes into comparison. There hasn't been a spread that much, which this signals, guys, that this is not looking good. This has predicted 4 out of the last 5 recessions, a negative inverted yield for the 2 and 10-year spread, okay? So this does not look good. I don't know how you argue against this, but somehow they are. We're going to keep watching it. That spread was tightening. That's kind of when rates came down back into the 6s. But this 10-year yield right here, 3.922. Mortgage rates were the low 6s just a month ago. We had clients lock their rate, which expires tomorrow. Rates are up an entire percentage point now, and it lags a little bit of the 10-year. So that means rates, 30-year fixed mortgage rates, 15-year fixed, 30-year jumbos, they are going to be moving north for the time being. So we will see rates back in the 7s, I believe, in my opinion. Just following what this 10-year is doing, it should be above 4 anytime now. All right, so let's get into the Southern Nevada market update. This is what I'm seeing in my market. Use it for what you will, but this is what I'm seeing. The absorption rate continues spiking as inventory continues to drop and sales accelerate. So I've been tracking this since August 8th, 2022 on this chart, where the absorption rate figure here was above 27%, and then we dipped down below 20. Anything above 20 is considered a seller's market, whereas below 15% is considered a buyer's market, and everything in between is kind of considered a healthy market, which could lean towards seller's favor or buyer's favor. But look at this. We have since January 30th, where we were at 18.90%, we have jumped up above 20 again, and now above 30 this week. That's up 6.51% over 2 weeks from our last reading on February 13th. That's about 3.3 months of inventory available in the Southern Nevada housing market. Now, they say that 6 months is considered an even buyer's and seller's market. I tend to disagree with that because our population is much larger. Money moves much quicker. So I would say about 4 months of inventory is an even buyer's and seller's market. But this puts us at 3.3, and it is kind of crazy because everyone's talking about inventory is growing. Inventory is shrinking in our market. And that's really interesting because sales and under contracts are picking up as well. We'll talk about that in a second. Single-family homes remain $5,000 off the January median. Condo single families are sitting at $420 for the month of February. Now, we do have our closings tomorrow at the end of the month, so we'll see if that number changes next Monday. But they're down about $5,000 from January. They are down $5,000 from January to $420,000, down from their peak of May last year of $482,000. Condos did rise. They're up about $4,300 from January to $220 median. And townhomes taking a big hit, down $25,000. That's down from $325 to $300 so far for this month of February. And again, as I said, we had another steep decline in inventory this week after peaking to 11,344 available properties in October 2022. Inventory is now in Southern Nevada, sitting around May to June 2022 levels. Accepted contingent offers rose again to 903 for the past week, which is up 7.5% from the January 30th reading. Sales have picked up with inventory declining, which has has shot up the absorption rate figure that we just talked about. High-rise units are the only sector of housing that rose month to month, albeit fractionally, with a modest 0.86% increase. There are currently, that number is incorrect. There are currently 7,134 available single families, condos, townhomes, multifamilies, and high rises on the market. That's a decrease of 5.93% from 2 weeks ago. That's 423 less active properties on the market. I mean, as you can see the statistics here. We're down compared to the end of January 30th, when we compared these numbers to. We're down 834 single-family homes. That's down almost 14%. Condos down 8%. Townhomes down 7%. Manufactured homes down 8%. Okay, we are moving into a tighter inventory market, because if you're going to sell your property and you're trying to trade up or move down, you're not going to move down and have a higher payment for less house. That doesn't make sense. So the sellers who are selling, or people who have situations that require them to sell, such as their family's getting bigger and they absolutely need a new space, or they need to move to a different side of town for their job to lower their commute an hour, or they're moving out of state, or they got divorced, or it's an estate sale, those kinds of things are the properties that are moving. I'm also seeing foreclosures tick up just a bit in the market. Nothing crazy, but we are seeing more of them, but we are still not before pre-pandemic numbers. We will keep an eye on it, because a lot of these forbearances are starting to end. We still have properties in forbearance, and Penny Mac and Fannie and Freddie are actually allowing extensions of these forbearances. If you just call and say, hey, we need to extend this, they're doing it. They're giving you another month or another 2 months, and people are taking advantage of that. So that's going to be something interesting to watch. All right, so let's predict what's going to happen this week. The January pending home sales index of signed contracts on existing homes should be up, indicating sales gains going forward. Construction spending is also forecast up overall, but we'll see about the residential part. ISM manufacturing is expected to remain in contraction territory, though ISM non-manufacturing is predicted to show the far larger services sector expanding. I want to know what your guys' predictions are for this week. Go ahead, let me know in the comments. Real estate tip of the week. Here's a checklist if you're selling your house this spring. Get the email so you guys can get this, print it out, check it, use it, whatever you want. But if you guys are getting ready to sell your house this spring, and add these items to your to-do list, okay? Make it inviting. You want to make your home as inviting as possible. Open the blinds or curtains and let that natural light in. Check all your light bulbs. Make sure your lighting is good. Take down personal photos or items. Let people visualize the space and not be influenced whether they like your family or not, okay? Fix anything that's broken. Clean your toilets. Have the toilet seats down. Give every room a clear purpose, okay? Show that your home's cared for. Clean your baseboards and your vents. Nobody likes to look up at your air filter and it's just covered in dust and nasty. That shows buyers that you do not take care of your home. Vacuum mop and sweep the floors. Declutter throughout. Remember, less is more when trying to sell your home. Organize countertops, cabinets, and closets. Touch up any scuffs on the wall. And to burst your curb appeal, which is the first thing people see. They pull up with their agent. They see your beautiful house. You want to make it look as beautiful as possible. Power wash the outdoor surfaces. If you got oil stains all over your driveway, clean that up, guys. If you got weeds, pull them, all right? Clean the windows inside and out. Let it shine. Tidy up the landscaping. Pull those weeds. If there's rocks not where they belong, push them back, all right? Tidy it up. Freshen up your entry. When they walk into your entry foyer, you want to have it nice and open and clean and something that smells good. Warm apple pie, fresh baked cookies. Give them a great, play with their senses. Sweet patios, decks, and walkways. Just have everything clean. It shows that you care about your property, and prospective home buyers would like to know that you cared for your property before buying it, all right? If you guys have any questions about getting ready to sell your home, give me a call. I would love to help you. Now, we're going to end with our Federal Reserve watch. If you guys remember, they were saying that we're going to have a pause, right? They're going to go 2 rate hikes. They want to give above 5%. They're going to have a pause. I felt they needed to keep raising rates. Now, they have increased the consensus at the March 22nd FOMAC meeting, there's a consensus. It'll be a quarter point hike May 3rd, a 100% consensus of a quarter rate hike, which will put that overnight rate at about 5.10%. And then June 14th, another quarter rate hike to get them to 5.25 to 5.5. So you'll be looking at a 5.35% overnight rate. And that's a 77.6% consensus amongst the bankster gangsters in Wall Street. And be prepared for at least 3/4 of a point over the next 3 Fed meetings total. That's what we got. I want to give a shout out to my guys that own the Stakeout Bar and Grill. It's under new ownership. Their staff is awesome. Their food is great. Make sure you check it out. They'll give you $50 in free play if you sign up. And if you hit 4 of a kind, you're entered to win 2 Vegas Golden Knights tickets worth up to $1,000. All right. Been a pleasure. I know this one was a little bit longer because I included the Las Vegas market update on this one. But anyways, I hope you're doing well. I hope you're blessed and healthy. Remember, control your thoughts because then you will control your reality. Just want to give a shout out to the UNLV Lady Rebels, ranked top 25, conference champions for the first time since 1990. Way to go, girls. UNLV Running Rebs have senior night on Wednesday, 8 p.m. at the Thomas and Mack against Utah State Aggies. Megan, I know you went to gym there. I know you're an alumni, but hey, baby, go Rebels. All right? We'll see you guys. Take care until next time. Hey, if you need anything, my contact information is below. Take care.